This is the World Financial Report on Radio with Harold Siegel. My name is Randy Marshall. Joining us via the telephone, our financial expert, Harold Siegel. We're taping the show on September 30th, 2011. Our time is 8:49 in the morning Mountain. That's 10:49 Eastern. Radio show runs on AM 640 in Toronto, 630 CHED in Edmonton. If you ever miss a radio show, the shows are archived on Harold's website, HESradio.com. You can listen to them anytime. Go back and listen to old shows, HESradio.com. This is 1 week where you want to get our newsletter. If you're wondering why things have happened in the precious metals markets, other markets, all the information is in our newsletter. We will go throughout the entire show and talk about it, but if you want to read further, I encourage you, get our free weekly newsletter. Call 1-866-623-2002, 1-866-623-2002, and we'll be happy to send it out to you free of charge by email every week. Harold, gold is still positive on the year. Silver, it started the year at $31, so it's flat to down a little bit. It's been a very volatile market for everything. Everything has been very volatile. And I still believe, though, the fundamentals are on precious metal side because, let's face it, there are serious problems over in the EU. They're going to have to print money. There will be quantitative easing 3 at some point, and I think we will see precious metals catch fire again.
Well, I truly believe that is true, and again, these are very confusing, and this has been a very stressful, frustrating, and confusing week. Actually, the precious metals markets, the currency markets, the commodity markets, and stock markets all around the world all fell substantially. Everyone seems to be reeling from the huge price drops and wondering, what caused it? Is it over? Will it happen again? What can be done to protect ourselves? And are we still bullish on the market? First of all, what caused the sell-off was actually very similar to 2008. Understand that these are probably the most confusing and volatile times that we've ever seen. And as we've said on past shows, the next 5 years are going to be the most volatile and the most confusing markets you've ever seen. So the fact is that we really need to be sharp about what's going on, and this is a very, very important show. We really have to realize at this particular point, the volatility in these markets and what we really need to do to protect ourselves and to continue to make money in these markets. First of all, there's a lot of different theories as to what happened this week and what caused gold ultimately to drop from $1,900 down to $1,500 and what caused silver to drop all the way down to $26. Again, those were not the only markets that fell substantially. Copper fell, oil fell, stocks fell. Almost every market fell this week. And again, it was a very, very frustrating week, and for many people confusing because we saw things happening that really shouldn't be happening. First of all, we have a lot of respect, obviously, for guys like John Embry. John Embry feels that the reason the market fell was because of central bank intervention, which really didn't make an awful lot of sense to me personally. On top of that, you've got a lot of analysts that are saying that J.P. Morgan or firms like that, these type of investment banks were behind the sell-off. But in all honesty, the way that I see it was the volatile leverage markets is what caused the sell-offs in gold, silver, copper, oil, stocks, and currencies. See, raising the margin requirements, which the CME did again, like they did back in April, that also escalated the fact, and it made it fall even that much further. But the fact is that raising the margin requirements, and that has to do with trading futures contracts, which we talk about every week, and we do not recommend to any of our listeners because it's so heavily leveraged and it's so dangerous. And in a week like this where you see silver drop from $40 down to $26 in such a short period of time, and gold ultimately dropping from $1,900 down to $1,500, again, most people can't understand why in the world that would happen. Every week we talk about the difference between trading the paper markets and the cash markets, or the physical market, and in actual fact, those that are sitting in physical gold, as an example, are still up $300 on the year. even though the market has been extremely volatile, there are no margin calls in owning physical gold. The only thing that happened this week is that the market dropped from around 1,900 down to 15 and change, and it's back up to $1,620 today. So you're going to see a lot of volatility in the market, and that will continue, and you need volatility in order to see higher prices. But the reality is that by raising margin requirements when the market was already falling, only escalated the fall that much quicker. Now, again, I'm sure that the Federal Reserve and the Chicago Mercantile Exchange and the COMEX Exchange and these exchanges around the world, they want to see the action in the market. That's how they make their commissions. But again, what we saw was heavy support in the gold market at around the 1680 level. We saw heavy support in silver at $32. And basically, $32 was very, very heavy support for silver, and that's where the market should have stopped. And I know that firms like Worldwide Precious Metals, a firm that we recommend, for our Canadian clients to buy gold and silver through, I know that they had stops in the market, and protected their clients down to $32 and $30. It was Monday morning when the market fell out of bed because of the Asian trading and the sell-off that happened Monday when the market fell $4. That was directly to do also with the fact that overnight, during the weekend, these margin requirements were raised, and that's what made the market fall that extra $4, and that's where, people got hurt. Aside from that, the market should have stopped at about the $32 level, $30 level at the lowest, and there wouldn't have been any major damage. But the bottom line is that these markets will remain very, very volatile as they have been, and we're not blaming anything on the central banks or Goldman Sachs or anything like that, because this really showed up in the charts. You could see that there was a gap in the charts that should have brought silver back down to about $32, and we were comfortable with the market at that level. It was only when the CME raised the margin requirements Sunday night and the Asian markets, fell heavily, and then when the New York markets opened on Monday morning, that's when silver fell $4 and gold fell almost $100. And that's the way that I see it. Now, the fact is that, is this going to happen again? Yes, of course it will happen again. These markets are going to continue to run. They're going to continue to run very heavily in gold and silver because the fundamentals are right for it. But there are going to be times when the leverage is going to be too high, and when the market gets overbought like it did in gold and silver, and then the markets are going to fall again. In fact, just to caution you, that could possibly happen in October. There's a prediction that October, first of all, is one of the worst months for stock market crashes, and there's a very good opportunity that we could see a crash coming in the market again in October with the stock market. We could see a sizable pullback in that market, and that could ultimately pull back gold and silver like it did in 2008. My recommendation is to hold the physical metal. By holding the physical metal, I mean, back 10 years ago, gold was at $250. It went all the way to $1,900. It's now back down to $1,600. If you own the physical metal, there's no chance of margin calls. You can't get in trouble owning the physical metal until the trend is over. And the trend in this market is nowhere near over. In actual fact, it's only getting started. So my feeling is that you want to be in physical gold and silver. The paper price is going to change from time to time. It's going to go substantially higher, then you're going to get your drops, and then the market's going to go substantially higher again. Let me take you back to 2008, which was a very difficult time because that's when the financial world almost collapsed. That's when Lehman Brothers went out of business. That's when there was a $4 trillion run on the money market funds, and it was probably, next to the Great Depression, the worst financial time that any of us have ever experienced. And that was a time when silver was at $20 in 2008, $21 actually, and it dropped in a matter of 4 or 5 days. It dropped all the way down to $9, and we thought that the financial world for us was falling apart at that point. But what happened is that silver at 21, even if you bought silver at $21 in 2008 and it dropped all the way down to $9 what it did, and you own the physical metal, we just hit $50 silver back in May. So these markets are going to continue to make these gigantic swings. But if you look at $21 in 2008, it dropped down to $9, and then it came all the way back up and ultimately went to $30 and then to $50. Now from 50, it's now pulled back to 26. It's now back at $30. What silver is doing right now is building a base again. I don't think that silver is going to make a move and run right up, back up to $40, $50 right away. It's got to build a base. It's not the way the market trades. It just doesn't go from being at 50 going to 26 and then back up to 50. That doesn't happen. In actual fact, it's a slower climb to the top, and it's an elevator ride down, back down to the bottom. But the bottom line is that, as Randy said at the beginning of the show, the fundamentals have not changed an iota. In actual fact, what we're going through is some of the most difficult financial times, and you've got governments that are basically reeling from what's going on. Financially, they are just so confused as to what they can possibly do to get these economies going again, but that's not going to happen for quite a while. The bottom line is that the U.S. economy cannot thrive again until the consumer starts to spend, and the consumer is tapped out. He's broke. So we've got 5 years of these type of markets. We've got 5 years to make an awful lot of money if we do the right thing. Please don't get discouraged by the fact that silver dropped from 50 to down to 34, like it did when they raised the margin requirements, went back up to $44, and is now sitting basically at around the $30 to $31 level. Now, again, silver will build a base, but the fact is that if we do see a stock market crash in October, which is possible, watch for volatility in the gold and silver markets again. Again, the strongest recommendation that I can give to us at this point, as you can see, it's not only gold and silver that fell, the stock markets all over the world fell substantially. The other thing that goes on in these type of markets, like this weekend and the early part of last week, is massive margin calls in all markets, because stocks aren't bought anymore for $1 worth of stock for $1 worth of money. These hedge funds buy $40 worth of stock for $1 worth of money. It's a 40-to-1 leverage factor. So when stocks are going up, they're making a fortune. When stocks are going down, they're losing a fortune, then they have margin calls, and then they sell their gold and their oil and their currencies or whatever has any value, because as most people now know, when a margin call gets hit, you've got a couple hours to get your money in, otherwise you get sold off. And that's what's happening all over the world. So when these margin calls were not getting hit, these exchanges were selling everything that they possibly could because they had to pay out the margin. So it's a very, very volatile and confusing and frustrating time for most traders when these things happen. You know, these markets are an awful lot of fun when the markets are going up and up and up every day. But when the markets go down and against us, you know, it's very stressful, and nobody ever wants to lose money. Again, these markets are going to continue to be volatile. We've got two choices. Either we play the game correctly, or we get out of it and just sit back and watch the markets do what they're going to do. My recommendation, and has always been, is to be extremely conservative. You know, not to heavily leverage anything, not to speculate, because if you look at gold, when we first recommended it and bought it back at $250, there's been 10 or 11 of these gigantic price differences, and during the time that we've recommended this market. We've been through 10 years, a decade of trading gold and silver, and we've seen 10 or 11 of these catastrophic falls in the market. But the bottom line is, if you bought gold at $250, and even though it went to $1,900 and it's at $1,600 now, you're still up, you know, tremendously on your position. But if you're leveraging your position, you're going to get knocked out of the market from time to time, and this is what happened this week. Everything would have been fine if they didn't raise the margin requirements on Sunday night and everybody got hammered Monday morning when silver dropped $4. It's got nothing to do with the fundamentals of the market. Europe is still going under. The United States still owes, you know, $15 trillion and can never pay back that money. You know, right now, by bringing down commodity and metals prices, they think that they've suppressed inflation for the short term. There's no way in the world that that has happened. Inflation is the number one reason why we are buying gold and silver, and that is not going to change, because there's no chance that we are all of a sudden waking up on this day and saying, phew, everything is fine now, this was just a bad dream, all the economies around the world are great and we're rich again. That is the farthest thing from the truth. The truth is, we are heading into the next 5 years, which is going to be the most difficult times you have ever seen, and if we're not prepared for it, and if we don't do it correctly, quickly we're going to be in financial trouble. Again, we're still up tremendously on our recommendations in gold and silver, oil, and everything that we've recommended. These pullbacks are buying opportunities unless you no longer believe that these situations in the marketplace are important anymore. My feeling is I haven't sold an ounce of my gold, an ounce of my silver, and on this pullback, I will be a major buyer of physical gold and silver. There is no doubt that we are still heading in the right direction, and all this is going to turn out just like in 2008 when silver dropped from 21 to 9, just another phenomenal buying opportunity.
And I would really encourage you to get our free weekly newsletter. The newsletter is packed full of information as to the why of what's been going on here in the last 2 weeks. And you can read all the different theories and philosophies. We'll send it out to